It's now my pleasure to introduce our two main speakers today. First up, we have Professor Michael Mainelli. Now, to describe Michael as a man of many parts would be a considerable understatement. He began with rocket science, literally, and subsequently qualified as an accountant, computer specialist, investment banker, and management consultant. Along the way, he co-founded a leading think tank, which until about an hour ago I was pronouncing as ZN, but which I have since learned should be American style ZN. Anyway, it promotes social benefit through finance and technology, so very much in tune with these meetings. In addition, he holds an emeritus professorship at Gresham College and is an acclaimed author, and somehow he also finds time to be an alderman and sheriff of the City of London. And I discovered just even more recently that he also plays the bagpipes. So how many talents does this man have? Michael gave a talk, which in my view was one of the highlights of Jeffy's annual conference last October. So I, for one, am eager to hear his views on how carbon pricing should best be approached, how it might be allocated across asset classes, and whatever related issues he intends to enlighten us on. So over to you, Professor Mainelli.
Thank you very, very much, Graham. And I'm just going to share some slides. One of the interesting things I found in this age of Zoom is I can never tell if the slides are showing. Are you seeing the slides correctly, Graham?
We are indeed.
Oh, fantastic. But one of the good things about video conferencing is you can convey a lot of information quickly because the audience has got the slides right under their nose. So I've got quite a bit of ground I'd like to cover in my 15 to 20 minutes. And I'm more than anything looking forward to our discussion. So what I'd like to look at is just a little bit of adjustment on what has been the green finance timeline. I'd like to talk about what's so special about green finance. And then I'd like to give you some of my views on the way that things are going and where we might put more effort. In addition to all of this, I've been asked to have a quick look at the efficacy of the carbon markets, and I will touch on that directly. So just as a reminder of where things have been going, the city's story so far is actually quite an old one. The City of London Corporation passed a local Clean Air Directive back in 1953, which led to the later Clean Air Act of 1956. So the city's been around in this space for a very long time. In fact, I had my first debate on climate change when I moved from doing some digital mapping projects around the world. I moved into the city in 1984, basically to put computers into finance. And I had my very first debate on climate change some 37 years ago. And that debate would end where it would end today, which is society really prepared to pay for it. Now, along the way, and nothing to do with me, we've had a whole host of initiatives, the Carbon Disclosure Project, the Stern Review, et cetera. My role in the city has included things like creating the London Accord, which is an agreement to share investment research, and also published, believe it or not, before the Stern Review was commissioned, we published an 800-page book on the investability of climate change. The City of London's also made submissions to areas like Copenhagen, where we put forward for the first time internationally policy performance bonds, which I'll touch on briefly. And we also created effectively the unburnable carbon stranded assets debate that is around. It started off as a project in 2006 called Burn It All. Where were all of the assets on balance sheet? And finally, my firm produces the Global Green Finance Index. So we're looking at where centers are going around the world. So there's a lot going on in the city, and it's been this way for quite some time. And I find it interesting that people often accuse people who work in finance of ignoring the issue. I've often said to my green cohorts that really what you're seeing here is not that the city's against it. The city's kind of a sausage machine. If you want to change the sausages, change the inputs. So finance should neither be green nor not green. Now, from our index, we look at a whole variety of green finance centers based on two axes, depth and quality. For those of you who are interested, London has been falling slightly in what's called quality. You get good advice in depth. You get good advice in London, but what you often don't get is the heart in it. And you can see here a whole variety of centers, Amsterdam, Copenhagen, what have you. It's probably true to say that hitherto, green finance has been largely a Western European affectation, and most of the leading centers are in Western Europe. But that is changing extremely rapidly. I think much more rapidly than people even in the green finance appreciate is the speed at which Asian centers in particular are rising. And I think many of us have high hopes for the US under the new Biden administration. So the point I'd just like to make here, though, is why is finance that's green special? We don't have shoelace finance. We don't have Hoover production finance. And the biggest thing that makes finance green is that this is a sector which is extremely dependent on government policy decisions. A green energy project is no different than any other energy project. You need to find a site, you need to work out your production costs, you need to figure out what the market might do in the future. But at the end of the day, you're very dependent on government policy. And I'll come to that towards the end. What's actually on practitioners' minds at the moment? Well, this too, I think, is somewhat revealing. It is interesting as you push green finance, how rapidly people begin repeating green bonds, green bonds, green bonds, as if there's very little out there. But in fact, there is very little out there when compared with the variety of things people have spoken about. Most practitioners are focused on green bonds, infrastructure finance, renewable energy, and social and impact investment. So ignoring, in fact, a whole variety of other areas that ought to be flourishing if green finance is so important. At the moment, financial institutions are gearing up as ever. This is a slide produced in conjunction with the UN and Mark Carney, and they're talking about the fact that financial institutions really should be incorporating green and sustainability in every single decision that a financial services firm takes. Climate change should feature in reporting, risk management. It should be a source of innovation, and we want to have returns, and multilateral development banks ought to be involved in it. Well, this all sounds very, very good, and absolutely nothing wrong with it. I'm not claiming otherwise. But what is interesting is that we have made over the years extremely little progress, believe it or not, in achieving much. And I think that where we're really needing to move is from plans, which are insufficient, into real economics. Now, we had a great opportunity to incorporate real economics, which began really in the 80s with a bunch of US policy wonks who decided that they wanted to tackle the sulfur dioxide markets in America using tradable permits. And this was, I think at the time when it was launched, which was 1992 or early 93, the presumption was that maybe over 10 years, they might reduce sulfur dioxide emissions by 20 or 25%. In the event, they reduced sulfur dioxide emissions by nearly 50% in 4 years. And so they went to Kyoto absolutely pumped up that this is the way to tackle a far bigger problem of carbon emissions and carbon equivalent emissions. And they left Kyoto with that being the decision. Now, on that previous timeline slide, a group of us in the City of London picked this up in 1998 and wrote a report on what trading emission permits could mean for the City of London. We ran the shadow trading market in the City of London Corporation for 3 to 4 years before it was picked up by the EU in late 2002, early 2003. And that traded market became the ETS that was launched in April 2005. Now, many people say that the ETS was a failure. I actually claim it's a success. The market worked. The permits were roughly double the amount that were needed, and the market did what it should do. It said supply grotesquely exceeded demand. And the price, which had been at its launch, the governments of Europe swore, in fact, they kind of put their hands up and said, we, the governments of Europe, do hereby swear to keep the carbon price above 25 euros a ton. The price plummeted to pennies. And the market was functioning. What we had, of course, was people lying about the number of permits that they needed and the number of permits that were actually in circulation. Now, that market has bumped along for a while, but it has recently resurged in the last 2 years. I did get a pretty catty comment from a colleague in Brussels who said the reason the market was now functioning much better is that one of the biggest liars had decided to leave the EU. I won't go there, but you can see some of the feeling in this space. And what we're saying here is really these plans are all very, very good, but the real progress is going to be made via economics. And we want to move from this sort of too much focus on top-down pressure on capital allocation to the idea that billions of bottom-up decisions, not just by banks, are being made incorporating, in the economist's term, internalizing the externality of carbon. And I'm sticking to carbon. There are other obvious environmental issues out there. I might point out that this sort of internalization does work. I frequently point to an example, which is that in 2011, the miles driven per capita by Americans dropped by 4%. Why did it drop by 4%? Was it because suddenly they were listening to the Sierra Club? No. What had happened was that the price of oil rose by 32%. And so people really respond to these types of pressures. And awareness, frankly, is just not sufficient. We've had Extinction Rebellion awareness. We've had many other awareness campaigns. We had Earth Day back in 1970. So this is not a new issue. But what are people going to do? And what they're going to do is to make billions of economic decisions. And we need to internalize that price within them. Now, we are trying, I would say indirectly with this ESG approach, to put that kind of top-down pressure on capital allocation. I might point, though, to some people my age. I did the marches anti-apartheid where we had the same pressure, which was to try and pressure South African firms to fight against apartheid because shareholders were loath to hold their shares. And in truth, much as I may or may not be proud of what I intended to do, I seriously doubt that South Africa did away with apartheid because of our protests and pressure on our universities' portfolios. So what I think we need to move to is a richer view. We in the financial sector feel we've kind of done our bit with ESG shareholder value, but I believe we've got a lot more to do in encouraging regulators to internalize. In fact, we have an obligation, an ethical obligation, I would contend, to the market itself. Some interesting work done by Henderson and Ramana at Harvard 7 or 8 years ago, pointing out that if there is an ethical obligation of somebody who works in markets and believes that they work, is actually to prove to society that they are working beneficially. And therefore, you have an ethical obligation as a participant in the market to root out corruption, to prove to society that this approach is better than regulation or taxation for the sorts of purposes to which you said to society you can deliver. Now, that doesn't mean regulation isn't needed, and it certainly doesn't mean that taxation won't stage a play. But I think that we gave up far too early back in 2007 on internalizing the carbon price. And it's interesting, of course, that China has actually implemented this year a national ETS system for China. So even the communists believe that the market is the right way to do it. And I believe that we should be looking at that more seriously. Now, I've been asked to talk briefly about the carbon market itself, and there's two ways to do it. So I'm going to be somewhat shallow. How are the emissions calculated? What assumptions are used when allocating this? Well, the honest answer is that what you should be doing is taking an aggregate amount of emissions that you wish to emit, perhaps on a per capita basis, and simply drop that year on year until you meet your target. So in rough terms, the average Briton emits 8 tons of carbon a year, and we should be aiming for 0 in 2050. And you can straight line that down and work out what ought to be done. In practice, at an EU level, there are all sorts of national competitions about how much is given, opt-outs for various industries, and the carbon, it really only covers about 50% of EU carbon emissions. But the biggest assumption in all of this is energy consumption as a proxy for the amount of emissions that are being made. Personally, I don't have too much problem with that being the proxy at this stage, principally because the IEA numbers, the International Energy Association numbers, agency numbers, are extremely good and correlate almost perfectly with carbon measurements in the atmosphere. It is an astonishingly clear correlation, and one that I frequently use when I'm dealing with people who don't believe that mankind has actually affected carbon. That sounds like an antiquated debate, but it's still alive in many corners. The second thing is carbon pricing achievable? Most definitely yes. And emissions trading schemes, as I said, have worked in sulfur dioxide, and they could work in carbon if we had, across the governments of Europe, not issued too many permits. A lot of people don't talk about voluntary carbon credits. These to me are far more dubious. They're dubious in a number of ways. One, they're fragmented. Secondly, the schemes themselves deploy a wide variety of technologies and techniques, ranging from forestation to drying out algae to plowing carbon back under soils. And whilst they may be very good, they're extremely hard to compare. Further, many of them rely on extremely long-term sequestration of carbon. So if I'm going to put it into a forest, I give you a 25-year credit, and in year 26, I cut the forest down and burn it. Well, what sort of credit was that? That doesn't mean I don't think more work could be done in this space, but frequently when people brag about how cheaply they got their carbon credits, I just flew across the Atlantic and I emitted 8 tons, and at the current price, that's approximately 200 euros. Well, great, but I've managed to offset my 8 tons for 10 quid, but because I'm doing some tree planting. Well, it does feel as if the market's a bit strange there. And I've often said to people, if you really care, go and buy an EU ETS permit and don't use it. That is actually almost the guaranteed way to do it. And this, I think, shows up one of the problems that you hear when you listen on the radio, that if we're all just a little bit more aware or whatever, we can save the planet. The truth is, if the price is 25 or closer to 30, I think last time I looked, that's basically 200 to 240 euros per Briton per year. Multiply that for a family, and you can see why politicians don't want to go on to television and say, I was chatting to an economist who knew his numbers, and guess what? It's 1,000 euros a British family per year. And this is, I think, one of the things that I find very difficult. It goes back to that 1984 debate that I had in the City of London, is people in the City of London tend to be a bit like me, a bit wonky, a bit nerdy, and a bit wedded to numbers. But when you multiply those numbers together, that's the real look at it. And I suspect to many of the 183, because I do love my numbers, people out there, this is probably big news that the cost is as high as that. In fact, you've probably never tried to do that back of the envelope calculation, and very few people who present do that. The third question I was asked was, how do banks decarbonize their loan book? And my honest answer is, why should they need to? Do they need to? Banks don't risk their books in many, many other respects. Now, that's a bit of an extreme position, but the point I'm trying to make is that if somebody has actually had to use internalized carbon prices, then they will be watching and decarbonizing as much as they can in a competitive situation. And the bank can look at much more traditional elements, such as their credit worthiness, the amount of the loan, repayment periods, covenants, etc. The final bit is carbon being fairly allocated across all asset classes, or equity asset managers being unfairly punished? Well, I don't know about equity asset managers feeling punished, but I will say that one of the difficulties we have at the moment is an alphabet soup of ESG models and taxonomies, with the British government threatening to bring out its own taxonomy. And one of the difficulties there is taxonomies are clearly susceptible to gaming. And firms can find ways to push themselves in or out. Far harder for them, at least in the carbon and climate change sense, to avoid paying for their emissions of carbon if there is an effective market in action. So what would I propose to end on a slightly more positive note? I don't mean any of this to be negative. I'm just trying to give a sort of a realistic pitch here. Well, I think the first thing I'd point out is that a carbon tax is pretty equivalent to tradable carbon permits if they're auctioned and priced rather than given away. But one of the things I'm particularly keen on is an area called policy performance bonds. We first wrote this up some 16 years ago and pushed it. We found very little uptake within the, I might call it the Anglo finance communities, and we took it over to France, believe it or not, at the request of the French government. And starting in 2018, Danone, Louis Dreyfus, et cetera, began issuing policy performance bonds. They go by a variety of names in translation. So you've got ESG linked bonds, sustainability linked bonds, performance incentive bonds. But the basic idea here is that if a company fails to pay fails to succeed in achieving its targets, the failure on those targets is linked to a percentage increase in their repayment schedule. And what's interesting about this, of course, is it does away with a lot of the ESG issues and taxonomies. So people are issuing these against broad SDG goals. For example, one bond has come out which includes within the measures the number of women on the board. There's a bond in Malaysia that focuses on achieving and helping the local community to attain educational targets. So you can pick any kind of social target that you like. But the original paper was very much about bringing these bonds out in a government sense. And I'll come on to that as I close. So there are multiple viewpoints out there. You've got the kind of the top-down rules of regulation and ESG value. You've got the bottom-up economics where tax and the internalization of costs force people to change those billions of decisions. And that's where I'd like us to add more impetus. And then, of course, you've got the traditional divide that this is a government problem or a market problem. And I would like to push, as an economist, as a financier, as somebody who works in the markets, as much as is practical into that top right quadrant of internalization. Make economics work. Now, one of the proposals we've got at the moment, believe it or not, is to issue a policy performance bond before COP in discussions with people in HMT and other areas of government. And it would work in a simple way. You're looking at a target from last year of dropping 3.45% per annum. If you're over the target, you pay interest on it. If you're below the target, you effectively get free government money. So a lot of things that you could do in this space. And this would allow large portfolio managers, for example, to hedge. They're currently hedging against government policies by buying fossil fuel companies, and they're buying that at a rate of about 8-to-1, which shows you the amount of confidence that they do have in the government. What we'd really like to do, though, is to be able to issue these bonds in some form of quantity. And in fact, in some ways, they would also help, I believe, with avoiding some of the carbon dumping wars. Now, I put this slide up. You just have to have faith in me. This was a slide that we showed back in 2007 on the policies that needed doing as a result of the London Accord. And I'm afraid that 13 or 14 years later, it's pretty much the same slide. Focus on the carbon market, try and use the pricing to avoid dumping wars, try and set some binding international standards rather than a plethora, try and raise those standards locally in terms of regulation, and admit that there are areas of research that need doing. And many of the things that are bandied about on the impact of forestry don't as yet stand up to serious examination. Doesn't mean that they're wrong, just means we'd like to see more research in support of it. So I'll close on our Accounting for Sustainability session with really just trying to point out that, as I opened, government policy risk is the distinguishing factor in green finance. And COP26, I think, gives us a unique opportunity to remove or at least ameliorate much of that policy risk by binding government to its own targets. That we do need to move and recognize that this is not so much a market failure in the sense of correction via regulation, but a market failure that is correctable by internalizing an externality, and thus a focus very much on making the carbon markets work is something I would like to see us in finance put our weight behind. So I'll thank you now and hand back to Graham. It's been a pleasure to be able to deliver some of this thinking to you. Much of it, well, all of it is freely available on our various websites and around, and I look forward to our discussion. Much appreciated.
Many thanks indeed, Michael. Huge amount of ground covered in a short space of time there, and I've little doubt we could quite easily fill the remainder of this meeting with the questions and comments that you will have stimulated. But before we move on to that, let us hear from our second speaker today, Jon Williams. Jon was a career banker, rising to become head of Group Sustainable Development at HSBC, before moving over to lead PwC's Sustainable Finance and Responsible Investment team. His focus is on ESG issues and in particular climate-related matters, including carbon markets. Jon is a member of the Task Force on Climate-Related Financial Disclosures, known to us all, I'm sure, as the TCFD. And one of his principal roles at PwC is heading its advisory work on the implementation of the TCFD's recommendations. He is, or has been, involved in a huge range of advisory bodies in what one could broadly call the green finance sphere, and also chaired both the Equator Principles, providing a global ESG benchmark for project finance, and the Climate Principles, which provide a framework for the financial sector's response to the climate crisis. Jon will be guiding us through the current reporting frameworks and how far these address climate and carbon risks. And we'll also be looking at the implications of net zero and what more will be needed by way of metrics and accounting to support the transition. I see we have some questions in already, but can I just remind you to send in these as they occur to you, as we'll be moving on to the question and answer session next. For now, though, it's my pleasure to hand it over to you, Jon.
Graham, thanks very much, and thanks, Michael, for a brilliant talk. I could probably spend my slot responding to that, but maybe pick up a few points. And also thank you to Geffy for organising this and to everybody for dialing in. Hopefully everyone can see the slides that I've got up, just a placeholder saying accounting for sustainability, net zero, myth or reality. I'm sure Sam will tell me if the slides aren't visible. I have spent the last 2 days in the TCFD plenary meeting. We meet every 2 months. We have a fairly full work schedule, 2021 coming through to 2022. And you know, I'll touch on a little bit of that. But really what I wanted to talk about net zero. But the reason for mentioning the TCFD goes to the heart of what we're talking about here. We've been talking about metrics and targets. We put out a consultation paper saying what is the right metric for financial institutions that is both forward-looking and financial. So the real end game of TCFD is forward-looking financial metrics. And realizing between the financial service members and the non-financial service members that this is not very straightforward. You know, to Michael's point, there's an alphabet soup of different standards. You know, the TCFD has pulled together a set of recommendations, including metrics. But you know, getting to, for example, a simple implied temperaturized metric requires a huge amount of data and the further development of methodologies. Sitting behind them has to be an understanding of scenarios and the data and the methodologies that drive those, and the level of information on your customer if you're a bank, or the investing company if you're an asset manager or an asset owner, that you simply don't have today. You know, where are the precise location of operating assets within that company? So we set ourselves a challenge to try and fix some of that during the course of this year and probably into next, and you know, we will continue to keep people updated. As I was thinking about this, I was thinking about what do we mean by net zero? You know, there are over 1,500 companies that have made net zero announcements, 50 plus governments, over 1,000 companies that have got science-based targets that they've committed to and are either developing them or have developed them. But when they make the announcement, what do they really understand net zero means? What is the challenge? How will they get there? And you know, at what sort of pace? And if I move on to my first slide, this is our Net Zero Economy Index. We've been producing this for about the last 12 years at PwC. It is a combination of a long-run macroeconomic model and then a series of carbon transition pathways across about 50 companies. And so this is the global view, time across the bottom and carbon intensity as a normalizing measure of economies. And the good news is, on an intensity basis, not an absolute basis, we have been decarbonising over the last, sort of 20 years. Although obviously absolute emissions have continued to rise, just not as fast as economic growth. If we continue at the rate we achieved in 2019, then we will go along that top sort of path, the dotted line, and we will commit ourselves to somewhere close to 4 degrees of global warming from pre-industrial levels. And scientists will tell you that that will be pretty disastrous for the economy, for the environment, and for society. what we really need to do is to get all the way to the other end, the 1.5 degree decarbonisation rate, because that rate will get us as close to net zero as we can, with the balance being covered by offsets. And even the Paris Agreement only gets us to 2 degrees. And if you look at the NDCs that sit beneath them, probably at this stage only to 2.8 to 3 degrees. So the big hope for Glasgow, for COP26, has got to be that the targets are ratcheted up and to get us much closer to the 1.5 degrees that is embedded in the Paris Agreement and that scientists tell us is safe. So when I ask the question, what do companies and even countries understand by net zero? That is the challenge that companies have to go through. They've got to say, could I decarbonise on an average rate of 11.7% per annum every year for the next 2 decades? And that is a real achievement. When France converted to nuclear, they got to about 7%. The UK conversion to gas got somewhere similar to that. No economy has ever decarbonised at 11.7% per annum in history on a sustained basis. And therefore, this is going to be a very real challenge. And I hope the companies that have committed to net zero, including my own company, PwC, have really understood how it is that they're going to get there, what pathway they're going to choose, and when. And whilst the lines on this graph are beautifully smooth, we all know the reality is going to be somewhat different. The chances are that we will continue running on that dotted line, that we will have some sharp policy corrections, often in response to a physical climate event that mobilizes politicians to have more resolve. We saw that in the financial crisis with COVID. The problem with climate change is it's way harder to fix than fixing COVID. You can't simply make an intervention with medication and have a short-term lockdown on the economy and hope you fix climate change. So it is a very real challenge to get there. And therefore, I think we are going to see a point, maybe in the next 5 to 10 years, where there is a much more disruptive correction as policies are tightened. And it's that non-linear, potentially disruptive rate that I think is much more worrying for markets and for financial participants that operate within them. So that turns me to what is the role of finance. And to me, it's about providing the capital to help the economy transition from where it is today to where it needs to be in the next 10, 20 years to try and drive our economies down that bottom line. If I look at the sort of greenhouse gas reporting of financial institutions today, 80% of them, if you look at CDP data, will still talk about their own offices, their data centers, the air travel that their executives enjoy, possibly looking at some scope 3 emissions in their supply chain. Very few will say, this is the carbon embedded in our loan book, in our investment book, in our insurance underwriting. The role of the TCFD is to try and change that and to say, how do we begin to get to a point where there is financial forward-looking reporting on the impacts of climate change, positive and negative, on our business as a bank, as an insurer, as an asset manager or an asset owner. And to do that, you've got to have much better reporting by what I've often called the real economy, the non-financial economy, because at the moment, if you are a lender or an investor, don't have the level of detail that you need to enable you to understand where is carbon in my balance sheet or in my investment portfolio, and therefore, how do I move that transition? If you look at the money going into renewables, it's been sort of annoyingly stable over the last 3-5 years, around about 300 billion a year going into renewables. The good news is that you're getting more value per $1 million because the price of most renewable technologies have fallen. So that's not to say that the rollout of renewables has stalled, but certainly the flow of capital going in has remained constant. If you look at last year, the amount of money going into the energy sector for transition finance was 500 billion. And the reason I make that point is very often I hear the argument about we're going to exclude certain sectors or certain types of assets. You know, coal has been the sort of victim of that over the last 5 years. And actually, what we need to do is to find a way of transitioning those assets from where they are today to where they need to be tomorrow. And whilst I absolutely agree that new coal in developed economies such as the UK or Europe is something that we probably should avoid, the reality is that if you are in India or China or other emerging economies, coal will form an important part of your energy mix, albeit on a declining basis over the next 20, 30 years, to enable you to have economic growth and to support poverty alleviation. And if you look at the IEA scenarios, there is not a scenario they've produced that doesn't have coal in it. So that might be a controversial statement for some, but the reality is we need to focus on transition finance as much as on green or brown finance. If I look at the European Union and their EU taxonomy and sustainable finance action plan, and I'm looking forward to the next variant that will come out in March, April, you know, I think the point has been made that transition finance will be incredibly important. And therefore the sort of, you know, green versus brown is a bit like having AAA and selective default as the only two credit ratings that you're prepared to understand. If I think about, therefore, what are the challenges, and I've just put up a couple of waterfall charts, which hopefully you can all see. I mentioned before that very few banks and investors really understand the detail of where their money is going. I was a banker for 21 years. If some of that, I was a relationship director looking out for my clients' interests. And the number of applications I wrote where the purpose was general corporate purposes. And why did I say that? I wasn't being evasive, but my client, the finance director or the treasurer, wanted liquidity. They didn't want a bank telling them how they could move that money and finance certain assets. And I think that is one of the challenges of the green bond market, if you talk to treasurers, that they really manage liquidity and access to debt. They don't manage asset level financing very often unless it's a very large, significant asset where they want to do some off balance sheet lending. And it's much the same as if you're an investor. You know, if you are investing in fixed income or in equities, you know, unless you're doing real asset investing, you are investing in a portfolio of assets, some of which will be high carbon, some will be low carbon, and very many, frankly, you won't know the carbon emissions at the asset level. You won't know the location of the asset, so you have no idea what climate policy risks and physical climate risks your balance sheet or your lending book is exposed to. So people often say to me, well, the TCFD is about converting CO2 into dollars so people can understand. I also think it's about going the other way and saying, how do you convert a balance sheet where we have very long established, quite clear financial accounting norms that are understood by the producers of financial statements and the users of them, subject to audit, a lot of look through and transparency. How do you try and create the same if you're thinking about climate? And what I've got up in front of you is a restatement of a bank's balance sheet. I've removed the details to protect the guilty or innocent, depending on your point of view. And what it does is it restates the balance sheet into carbon emissions. So if I look at the left one, you've got a baseline of emissions that if the bank does nothing but grows at the rate that it has historically done, you will end up with that level of emissions within the balance sheet. And then you've got to look at, well, what different policy scenarios might affect me. So you need to understand your customer, where are their operating assets located in the world, because that's where policy risk is, not in the head office, but in all of those operating assets. You need to understand the different policy scenarios in each of those countries that are being applied, and you need to consolidate that up. And then you simply need to do that for every borrower. Now, there are methodologies that are top-down, which is a good place to start. So thinking about how economies and sectors of the economy reshape. But ultimately, if you want to make a decision around engaging with a client, whether it be sort of, a client in a bank or an investee company in an asset portfolio, so that you can decide whether you're going to continue to support them with transition finance, or at what point you may choose to invest. You've got to have that level of detail. And under these two scenarios, the first one is the sort of the current national policy scenario. You will get reductions because of those policies and very little effort, frankly, by yourself in retail lending, corporate banking, investments, etc. So you will be able to see a reduction in the carbon emissions in your balance sheet simply because of the actions that governments take to price carbon, put in place emission standards, remove petrol cars from the road, etc. And you will benefit from that as a provider of finance. That will probably help you remove maybe a third of the emissions in your loan book. So if you've made a commitment to net zero, which is based on an assumption that government policy will get you there, then you have residual emissions of possibly 60 to 75% of your balance sheet. And let's really understand what net zero means. It's about making a reduction in emissions as close to zero as possible, and then using offsets to get to net zero. And the math that we've done would say that if a bank took a current national policy scenario approach, then the cost of residual emissions in 2050, when one might expect an $80 to $100 price, would outweigh their net profits by at least threefold. So they will be signing a potential liability that is huge. So current policies aren't enough. What do you really need is you need a more ambitious scenario. And that scenario comes from two places. It comes from governments sticking to the commitments they make in COP26 and beyond. To Michael's point, in making sure that maybe using policy performance bonds issued by government, which I think was the original paper, if I remember it, Michael, to say if you default on your environmental policies, then you've got to expect to pay more for your debt, and therefore it gives you the incentive not to. So you need governments to stick to the targets that they agree, hopefully in Glasgow. But you also need to look at the mix of assets that you have within your portfolio and decide, am I going to provide transition finance to help those borrowers become more energy efficient, to convert to electric vehicles, to decarbonise production processes, lower carbon cement, lower carbon steel, etc. So that a combination of the economic move to low carbon driven by policy and your choice of investment, either investment to help a company move to net zero or divesting and redeploying, will get you much closer to net zero by 2050. And you'll then end up with a residual set of emissions, which are probably affordable within the cash flows and the profits of your institution, and will enable you to achieve the benefits of economic growth, which flow through to banks as providers of capital in terms of margin and non-funds income. It'll probably give you a very good role in terms of advising clients, because you've now got the insight to understand which assets they may want to dispose of, and therefore you've got a corporate finance advisory role, or to provide your balance sheet, or to give them access to the capital markets. And equally, if you're an investor, you'll begin to understand whether you're prepared to buy some of their debt or put money into their equities because you believe that they are climate resilient in terms of their strategy. I wanted to sort of give you an example, and rather than making one up, what I've done here is extracted that example from BP. So BP do an annual energy outlook, and what I particularly liked about their most recent one was they've been quite candid about the different scenarios. So if I take you across these four graphs, starting on the left-hand side, they have looked at primary energy consumption by source under different scenarios. So you've got the 2018 mix, and this is the global consumption, not specific BP numbers. And then you've got a sort of a rapid scenario, so that's a sort of 2 degrees scenario, a net zero scenario, therefore clearly more renewables, about the same with hydro, significantly less coal, and a sort of reduction in oil, natural gas as well. And then you've got the business as usual scenario. So they basically map to my 3 lines that I started this talk with. Then bringing it out into shares of primary energy supply, you can then begin to see how that affects under those different trajectories, the growth of renewables, so blue being net zero, therefore the most aggressive growth of renewables, and the most aggressive reduction in hydrocarbons, and clearly the other scenarios showing slightly more favourable outcomes for hydrocarbons and less so for renewables. They've then calculated a range of investment that would be required. So you can see under the light blue scenario, much lower investment in oil and gas and much higher in renewables. And you've got the ranges there, in the sort of 200 to 300 billion in a net zero for oil and gas, as opposed to, a sort of 800 to 900 billion. But there still needs to be investment in oil and gas, even in that net zero scenario. And so again, my point on transition finance. And then the final one, just shows you therefore the annual investment in wind and solar in particular, and how, what is the need of capital again in, dollar billions, showing clearly that a net zero scenario needs, over $1 trillion in 2035 of capital. And so what BP have done here for the energy sector, not publicly for their own business, is to say, how does different climate policies drive different levels of investment and divestment that will reshape our business? And clearly, in terms of access to capital for them and to the sector, being able to tell that story so that providers of capital, the finance sector, are convinced that the assets will not be stranded and that there is a divestment plan which somebody can participate in with finance, but really a redeployment of that capital that is owned by the shareholders and lent by the bankers, that enables you to get return. So the sort of question we were asked is net zero a myth? I think hopefully what I've shared with you is it's not a myth, it is a reality, but it is a really quite tough reality. There are some easy wins, but getting down to that 1.5 degrees is a much bigger stretch than we are facing globally at the moment. The more companies that break down the national net zero plans that they're exposed to because of where they operate into their own strategies, the clearer they make, therefore, to lenders and investors and insurance underwriters that those plans are credible and consistent with a net zero transition, and therefore the enabling of the finance sector to also decarbonise because they're working with their clients and their invested companies to get there. And one of the sort of more simple approaches we've used is on the slide in front of you. They look like 4 rather easy boxes, typical sort of consultant oversimplifying things. But doing the impact baselining and working out what is the carbon content of my balance sheet is very difficult. The data doesn't exist. In some sectors it does. Household energy efficiency in developed economies often is publicly available or through subscription databases, but you try and look into the supply chain of a consumer goods company and work out what carbon is coming into their production processes, let alone the carbon imputed by the use of that product, can become quite difficult. But having done that, understanding, as I did with that waterfall, what are the different strategies in each of the different businesses I have that get me to net zero? And not just doing the quantification, but saying, how am I going to reallocate capital? If I think of carbon as a portfolio cap, a risk appetite limit on my balance sheet that is going to reduce over time, then how do I allocate that carbon across the different asset classes where I need to make sure that the different businesses will meet those carbon targets so that I can be on that trajectory to net zero? You can't set those targets at 2050. You need to look at what's my target in the next 5 years, 10 years, 15 years, and the Science Based Targets Initiative is one option to look at that. You've then got quite a large organisational transformation. There's the obvious stuff around embedding it into investment decision making, looking at product, services, R&D, etc., the infrastructure you need for a new business. But don't forget the people issues. At the end of the day, you've got to have the people within financial institutions that have this knowledge, that can have that value-added discussion with an invested company or a borrower, understand how their net zero strategy is or isn't going to be effective, and decide therefore whether to leave capital in place. And certainly if the EU follow through on, for example, embedding ESG into the MiFID framework, then every investment manager is going to have to understand the ESG preferences of each of its customers. And then finally, I would not be doing either my own profession or the TCFD a service without talking about transparency and reporting, because without that transparency and the progress that both the finance sector and the non-finance sector need to demonstrate that they are moving in step with government targets which themselves will get us to net zero, then it is really difficult for the finance system to understand whether there are asset price bubbles or carbon bubbles building up. Final comment from me, the role of offsets. Michael spoke about voluntary versus compliance markets. You will not get to net zero in any organisation with current technology, let alone in a financial organisation, without using some form of offset. Mark Carney's task force on the scale of a voluntary carbon markets is very much recognising that net zero requires 100 billion a year of credits to be issued, and that's clearly a huge scale up. But you've got to have quality over quantity. There is no point having an offset that is not credible, that is not long term, that isn't just kicking the carbon problem down the road, as Michael described. Plant some trees and burn them in 25 years, and hope nobody spotted the fact that you were just moving a carbon liability from one accounting period to another. So making sure they're really good quality offsets, that they're permanent, that they are subject to good standards, and they're verified to those standards will be absolutely key. And as a financial institution, understanding at what point you want to make that offset choice, because we're not talking about net zero today. That would be totally unaffordable for the sector, and in many cases will result in double and triple counting of offset requirements. But there will come a point between now and 2050, if you've made a net zero target at 2050, that you will need a really clear and credible carbon procurement strategy that enables you to genuinely say that those offsets are the equivalent to making the reduction where you couldn't. Final comment from me, what next? This has been very much a discussion around carbon and climate. If I think about the kickstarter for much of this at a policy level, it was the Stern Review, and it's taken to get to the TCFD, over a decade to get there. If I look at the Disruptor Review on biodiversity and natural capital, and the already formed task force on nature-related financial disclosure, I think the next big thing on the environmental side will be nature or biodiversity, way more complex than climate change, and climate is complicated enough. But that would be my forecast for the next 12 to 24 months. You could expect to see more action on nature, and it's just a shame that the convention that was going to be this year because of COVID is likely been pushed out to next year. So when I was listening to the video as we opened, they spoke about finance with purpose, something that really resonates with me. And for anyone working in the finance sector like myself, why do I get out of bed? Well, of course, I want to make sure that the capital flows into the parts of the economy that are required. And that if somebody leaves money with a financial institution, you'll give it back to them when they need it, maybe when they're retired, worth somewhat more than it's worth today, and hopefully with enough to live on. But in doing so, you won't have messed up the environment, that you'll have thought about how that money that you've been entrusted with is used to make the investments to drive us to net zero. And you'll have left a society that those people would wish to live in and retire to. Thank you very much.
Thank you very much indeed, John. It's coming back to me here. We now move on to the questions, of which we've had quite a fair number. And I'll start with, I will start with Michael, because it seems only fair, John, to give you a chance to draw breath after that very, very interesting and stimulating presentation. Here's a very, very basic question in a sense, but a very broad and open question for you, Michael, and then a more specific one. First one from Nicola Barber. How close are we to achieving binding international targets, and what are the sticking points? And then picking up on a point that John has just touched on, which is moving from climate to nature. Can we use the tools that you were describing, Michael, to address the specific examples raised here are deforestation and biodiversity loss? And that was from Theodore, I don't know if it's a Weber or Weber, but thank you for that question. So Michael, could you pick up on one or two of these things?
Delighted to. Thank you for both. On the first one, I'm answering here as a generalist to the state of the international agreements. The truth is, it's pretty poor. We have various things in Paris and COP, and we'll see more working in Glasgow. But the question is, what makes them binding? Hence the purpose of these bonds. Even were we to achieve it, we have another stage to go through. I called them carbon border taxes back in 2007. Today, the phrase is carbon border adjustment mechanisms, but basically countries are going to implement various types of policies to keep people out who are emitting in other ways. So let's take a simple example. I might feed my cows on certain feedstock that maybe isn't so climate friendly. They're emitting a lot of methane. And as I export my dairy products at the border, it's halted, and we need to have an adjustment tariff of some form to take account of the fact that I am emitting more carbon than is in the native country. This is a huge area of concern for me and for many people working in finance, principally because the greatest key to growth over the last half a century has been trade. Trade has grown from approximately 20% of GDP in 1970 to running on for nearly 70% of GDP. And that's really what's lifted everybody out of poverty in China and all around the world. That's been the biggest driver. And if you start impeding trade, you're going to wind up with a lot of other adjustments on poverty. So whatever you do, you'd like to keep it simple. And I can see this as just a huge minefield for vested interests. Oh, well, our dairy farmers need exclusions, and I've got carbon dumping wars. You know, it's the nasty steel plants in China that are burning coal. And you start moving into that area, and basically you've destroyed international trade, and you've ruined the consumer, and you probably haven't helped a jot in terms of helping carbon, because you're isolating people rather than binding them into the international system. One of the things you could ponder is, were it to become a convention, and I am very encouraged by the net zero carbon 2050 convention, which seems to be emerging. Where did this come from? People are latching onto it. They're declaring against it. I saw a comment there about Cumbria. You know, why would you approve Cumbria if you actually believed that the plant, and any plant like that has a lot of installed plant within it, machinery, if you believe that it's going to be useless in 29 years? So what I would like to see is, were a government, say, to issue a reasonable percentage of its debt in a policy performance bond, and that comprised a reasonable amount of GDP, might not need to be very much, 3%, 5% of GDP, and at least 10% of your total bond emissions. I will use the price that the market places on that to determine what the tariff adjustment would be in aggregate. So if you've decided to handle your methane in some way and you're emitting more, but if in aggregate you're on target to 2050, you'll see that the bond should pay 0%, therefore there's zero tariff. If the bond's yielding 1%, 2%, or 3%, well, then I will add that as a tariff to all of your goods and services, and keep it simple. But I don't see any prospect of a global agreement emerging anytime soon. And I don't think, I think I'd put my effort elsewhere. And this type of adjustment could be done via bilateral agreements and via trade blocks, and would, you know, be swiftly move to be about 80% of the planet. On the second question, which is forestry and biodiversity, despite the breadth and the depth of those questions, I can probably keep it briefer. Most definitely it could be used. And in fact, a couple of weeks ago, I saw that the Green Bond Initiative are looking, believe it or not, at a policy performance bond for biodiversity. I myself have made representations to various aid agencies and development banks that you could line up with a developing world country, take Haiti, for example, and say, tell you what, as you reforest, we'll lend you the money, not for reforestation, we'll just lend you the money. That's the great thing about these bonds. They're not hypothecated. It's not the use of the proceeds. It's basically you figure out how to get your forestry going and we'll lend you the money. And as you increase the forestry, say it's running at 15% and the target 10 years from now is 25%, as long as you're on that line, you pay 0% interest. Fall off that line and you begin to pay. I think that can work in forestry for the simple reason that it's largely measurable. Those in the field will know that I'm glossing over LiDAR imagery and canopies on forests, and I know all of that, but broadly in gross terms, you could do that. And in fact, one of the biggest objections to forestry would be people planting fast-growing species in waste areas to meet their targets artificially. Well, funnily enough, that's why I'm less sanguine about biodiversity. I think biodiversity is a tough one. I've had a very serious look at this over many years, not least 10 years ago with the National Environment Research Council. And it's the inability to measure biodiversity that causes the problems. And so my favorite elements for biodiversity are set-asides and reserves, which I've worked in the marine environment and elsewhere. And for large migratory animals like elephants in particular, which I'm quite fond of, corridors. And these sorts of set-asides are probably the only way we'll be able to handle biodiversity. But absolutely correct that this would apply to forestry.
Okay, thanks very much, Michael. Short but comprehensive. Jon, is there anything you'd like to add to that? And if not, I'll go on to a question to you.
I mean, I'll just very simply add that, making sure that a price for the externalities, particularly around carbon, are properly embedded into both economies and countries is really important. I was heckled at a conference a few years ago for saying that you should price nature and biodiversity, not because I felt that there was a price at which it could be destroyed, but rather that if you put a price on the free ride that people get out of it, then again, you will see economic capital moving to people that want to protect them. I've often heard the debate that, you can't monitor this stuff, the data doesn't exist. Well, I think, satellite imagery and drones are becoming a lot more used for monitoring at a very detailed level. Even at PwC, we've been using drones to do audits around the world in COVID because we simply can't go and do the audits that we have to do. An example of that being the Canadian Forestry Commission, where we do the audit of the forests.
Interesting. I'll move on to questions which I think are more in your territory. I'll take again two together. Firstly, from Graham Andrew, who says, big corporates will be scared in reporting that they have 50+% in carbon-related businesses. They will have terrible publicity and cannot immediately do anything due to legally binding loan agreements. How, as a country, can we help them be transparent and then accept their actions to reduce the levels? And then a second question, Nicola Barber, in relation to the BP scenario, which you shared, are the steps and CapEx priorities sufficient? How do long-only managers validate company disclosures more generally?
Shall I take the one around how to encourage companies to disclose?
Yeah.
The long-running debate, I think, around, for example, TCFD has been voluntary versus mandatory. And when we issued the recommendations in 2017, one has to recognise that we were, set up under the Financial Stability Board and the sponsorship of the G20 finance ministers. And the FSB itself is an advisory body. The ability to mandate sits at the sovereign level and not at a sort of G20 advisory level. And bear in mind, of course, we were, a year into a Trump administration, so we weren't exactly going to be able to push through mandatory disclosure, through the G20 finance ministers. I think a lot has changed since then. I think there is a growing recognition that voluntary has not worked at the pace that we'd like to. The status report that the TCFD produces every year very much outlines that we've made good progress, but on forward-looking financial disclosures and disclosures by asset managers and asset owners, we have a long way to go. And you're seeing in the UK, you'll see it in the EU and in a number of other markets, a move now to mandatory TCFD-like disclosures. And so in the UK for fiscal 21, i.e. the reports that come out in 2022, that will be mandatory in the UK for premium listed companies as an example. So there's mandatory disclosure, but I think there's also the power of the providers of debt and equity. Because if you've got two companies in the same sector and company A produces a perfectly transparent disclosure that says, yeah, half of our balance sheet is in carbon, we've got a plan to transition because we've done our analysis using scenarios and we know that our business will be worth less if we don't act now. And you have company B that says we're not disclosing because Disclosure Council said it would create liability, as an example. Then a rational investor is going to go with the company that is transparent and trusted than one that says we're not telling you. And I think, therefore, whilst I'm not a big fan of divestment, the TCFD gives both a framework and increasingly a mandatory framework for companies to disclose what their strategy is for dealing with the transition to net zero. In saying that, I've now forgotten what the second question was, but Michael, you might have remembered more about how can asset managers understand some of this in terms of the detail that we need to go to. But Graham, you might want to just read it out again. Apologies.
Yes, this was going back to where we were. Yeah, well, this was in relation to your BP scenario, which it says it provides a helpful and transparent analysis. Are there steps in CapEx priorities sufficient? How do long-only managers validate company disclosures more generally?
Yeah, so I think, what I'm certainly seeing within asset managers is, a build out of the required skills to do the analysis. So understanding, what scenario is a company using, what are the input assumptions, etc. What does that therefore mean for the value of the assets that they have, those that would be disposed of or decommissioned over time, and where that money is redeployed. I personally don't think it is the job of the asset manager to do the scenarios and the strategy analysis for a company they're invested in. If I was an asset manager, I'd be saying, please tell me what scenario you've picked, what are the input assumptions, what are the outputs, what does that therefore mean for the decisions you're making? Walk me through how you've done that, and therefore what you think the implications will be on your balance sheet, assets, liabilities, your cash flows, your margins, etc. It's the responsibility of companies to do that, and of the shareholders to say, do I believe you? And therefore having reference scenarios and standard metrics will really help somebody say, well, okay, what should an oil company like BP look like in 5 years, 10 years, 20 years, and how far have they gotten there?
Thanks. Before unless you want to jump in with something very specific there, Michael, there's one more here that's very much for you, John. So if you don't mind, I'll just hold on to you for one more question here from Matthew Crichton. You said that the role of TCFD is in part to show how to convert balance sheets made in terms of currency to balance sheets which also incorporate carbon. I understand that it doesn't exist or exist sufficiently yet, but what are the tools which accountants will have to use to do this? Does anyone know yet?
I think based on the discussion that we've had over the last couple of days, the answer is that we have part of the answer. One of the challenges, so, we put out a consultation on forward-looking financial metrics. We have proposed 2 or 3 metrics in that consultation, one being a weighted average carbon intensity, which works very well with asset portfolios, but recognizing that understanding the carbon emissions on a weighted basis from a portfolio, it doesn't tell you all of the impacts that may happen to from physical and transition risk, for example. Physical risks are not really much to do with carbon emissions, it's to do with location of assets relative to predicted weather events, for example. and transition risks are very much about where those assets are located. So knowing that company A has a higher carbon intensity on a weighted basis than company B only gives you part of the solution. The implied temperature metric is really trying to do what I was doing in the waterfall slide, which is to say, if you have an investment in a company, in their debt or their equity, what would the implied temperature be of that company's activities? And if you look at a good example, Legal & General, they've restated their investment book. They've split it into fixed income and equities, and they basically said that, and apologies if I get it the wrong way round, but equities is about 3 degrees, fixed income is 3.2. They have an average roughly across their book of 3.1 degrees, and therefore directionally have to get down to 1.5 degrees. Again, not all the data exists. You're making assumptions to get there. What they're not saying is, as we might understand from our accounting standards, this is the precise answer. What they're saying is, when we think about strategy, we know that a portfolio that's 3.1 degrees is a very long way from net zero and a very long way from where policy will take us over the next 10, 20, 30 years. Therefore, we've got to reduce that. And whether the reduction gets to 1.8 or 1.7 or 1.6 is slightly not the point. The point is that they will have shifted a huge amount of capital from where they are today to where they'll need to be tomorrow. So no, we don't have all the answers. The accounting profession doesn't have the answers. We've spent, this is our 6th year in the TCFD for what we were told would be an 18-month project. We're still working on that. And if anyone has any brilliant ideas on this call, please let me know, because we had over 200 and something responses on the consultation that we're working through as well.
Okay, is there anything you immediately want to chip in on that, Michael, or should we go on to another question?
Let's go on to another question. I could go on about that, because I think John makes some interesting points.
Okay, well, I'm going to throw 2 questions at you, two quite different questions, but they're both, I think, for both of you to respond. One from Mike Clark. Do either of you have a view on how we can make HM Treasury's Green Book more helpful to UK climate policy? He then adds, cost benefit would seem not to cut it for transformation activity. So that's one. And then the other one, which you very briefly touched on, Michael, the very topical issue of the Cumbrian coal mine. And the way this has been put by Andrew Ross is the Cumbria coal mine saves the cost of importing coal. Can green finance be ethically invested in it if the carbon emissions are net zero offset in nature-based solutions? And so you really want to pick up on that one first. Do you want to start, Mike?
Yeah, I'll skip on the call. I don't think if you are a green ethical fund and it's out of your ethics and you don't invest in it. If you're not, then you're investing on financial returns. I've made my point that I'm surprised that a coal mine like that, I'm not close enough to the decision, but I'd be curious how you're going to make it pay inside of 29 years. That's my core point. On the second one, which was just remind me here, we were.
This was the one on the HM Treasury's Green Book. Yeah.
Well, I think this falls. Mike's point is a good one. I would like to abolish kind of the Green Book in the bond area. So I know that's not what he meant, but to me, this whole thing is government's moving towards a use of proceeds type bond, which is a fairly traditional bond, and it's not hypothecated, and it's basically a grab list of projects, which, as we've realized with COVID, would have gotten funded anyway. I think in the sense of how you use HMT's Green Book, well, the biggest element within that, and John might have a view on this too, but it is broadly how you set the discount rate, whether it's the actual discount rate used in the project or the discount rate that you use in the sense of social. So is there a different social discount rate for it? But again, in a zero interest rate environment, or even negative, that question becomes rather moot. So I'm not too sure that the Green Book is the bogeyman that it was held out as up until about 2010. And then suddenly since 2010, it's disappeared. In fact, if you think about it, the Stern Review, which is a very eloquent exposition of the many issues to do with social and discount rates, it's astonishing how that was the big problem. And then suddenly the discount rate went to zero, but we didn't start thinking anymore long term. So I'm beginning to question that assumption in the first instance. And I wouldn't mind when after I've given John a chance, I wouldn't mind coming back on Donald McRae's point. But John, any thoughts from you on those two?
Yeah, I'm not an expert on public finance, but if, as is being debated in the EU, you end up with a, Brown penalising factor that recognises an internalisation of the cost and risk of carbon, then you need an adjustment to discount rates to say if you want to finance a high carbon activity, it will have a discount rate adjusted for the price of carbon, not today, but the price of carbon across the life of that asset. And therefore, if you believe a price of carbon in 2030, 2040 could be 50 to 80 euros a tonne, that's the price you put in, because you're making an investment decision today about cash flows that will be affected in the future much more significantly by carbon. I will pick up Andrew Ross's comment about coal, and this is not to say that I have reviewed the particular project, and I couldn't even possibly say whether we are or aren't involved, and that's not me hiding behind some corporate secrecy. I just don't know. But I am not against coal per se. But if, and we have done this for a client, you want to build an asset that has emissions, in this case carbon, that could become very constrained or very highly priced in a future policy environment. If you haven't done the sensitivity analysis on that asset at reasonable prices of carbon, or if as a lender you haven't done that, then you're not doing your due diligence. And I would also, like Michael, question the payback if a proper price of carbon is used and the cash flows are adjusted, but not at today's carbon price, as I say, at a future one. I'll put aside whether in the year of COP26, a country that says we want to be a leader, but we still want to use coal is another matter. That's a political comment, not an economic one, which is where I'd rather focus.
I wonder if someone would say something along those lines. Okay, I see that we're getting within 5 minutes of our conclusion, and I'm hoping not to run more than a couple of minutes over time, as I think we should do our best to live up to what we promised. So a couple of final questions, and again, maybe you could both pick and choose from them as you see fit. And you mentioned Donald McRae's, Michael, so we'll include that, which says, do I detect a request for groundbreaking new accounting standards on internalizing externalities? Do you understand that maybe better than I do? There's an interesting further question here from Fiona Ryan. What do you think about shadow carbon prices?
Well, actually, I'll try and combine both of those together in 60 seconds. Donald, I think, knows that I'm a proponent of confidence accounting, which is an initiative from the ACCA, CISI, but also has been written up by CIMA, the ICAEW, and CIPFA. And the idea here is that accountants need to start incorporating ranges in balance sheets and other material items so that you recognize the uncertainties. And I think that this is intriguing to me because one of the things that we found when we looked at the unburnable carbon situation back in 2006 was that people couldn't represent the range of potential value of the assets. If they were allowed to burn for 100 years on a 100-year plant, maybe it was worth the price of the oil times the amount in the ground. But if you took any kind of reasonable scenario, that tailed off once you decided society wouldn't allow you to burn it any longer. Hence why we called the project initially Burn It All ? One of the things confidence accounting would do would be simply to put ranges on these things. And a lot of the questions in here about the uncertainty, the methodologies, et cetera, is an accounting framework bumping up against a scientific framework. So in the scientific framework, you would represent all of these as ranges. And on the accounting framework, we practice basically 11th century Italian bookkeeping, and we come up with a specific number. And so a lot of these things would be there. Take the asset manager problem. The asset manager doesn't need to know to the penny. And in fact, that's the wrong method to use. What the asset manager needs to see is a distribution function on the valuation, and then to compare that relatively with the other items that he or she is considering investing in. And it's this sort of movement that I feel that we really need to get a grip on. And that touches in a weird way on shadow pricing. I mean, shadow pricing is a term that's used to, really refer normally to like the assignment of a value to an abstract commodity. that you can't obviously quantify so that you can make decisions in the absence of economics. So my whole point is get that carbon price working, then that really is the price. So you don't need a shadow price. But at the moment, and particularly with the UK having decided it doesn't know what it wants to do on ETS, you're lacking in the United Kingdom a real price anyway. And shadow prices, can serve a purpose, but don't forget that they're an analytical tool and therefore, again, susceptible to ranges. So I would like to see a lot of this stuff represented by us as accountants, working with the science. Scientists work in a different way than we do. They use ranges constantly, and we're always putting forward these point values. And I believe that we've got a lot of work as a profession to do to rise to that level of analysis that the planet needs.
Okay, thank you. And John, some final thoughts from you.
No, I would agree with Michael's last point. We can either be precisely wrong or roughly right. And I often see people trying to put precision between good information that will help you make a decision. And I would also argue that although my profession, practices precision, at the end of the day, there is still a degree of judgment required in terms of valuations, etc. So let's not pretend just because it's got a pound sign or a dollar sign or a euro in front of it that implies precision. It implies a degree of high accuracy. I also think for broadly ESG reporting, we have such an alphabet soup of standards that it's almost impossible for an investor to look at different sets of ESG data and make a decision. And we were looking at some data sets and the correlation was 0.09. That will tell you everything you need to know about how difficult it is to interpret some of this data at the moment.
Okay, thank you very much. Well, as I say, the clock unfortunately has beaten us. We could clearly go on for another hour, but I think, ladies and gentlemen, all that remains is for me to say a few words of thanks. First and foremost, of course, to our two distinguished speakers today. I think there will be a unanimity that we chose well in finding true experts in these subjects, insofar as you would be the first to say, I'm sure anybody can be. Can I remind you that this whole event has been recorded, and if, like me, there's several things here that you feel you would need to hear a second time, then that will be available in a few days' time, as I mentioned. So thank you very much again, Michael and John. Thanks also to our own Jeffy team, in particular Natalie, but also those behind the scenes. These events don't happen without a lot of hard work, and we're very grateful for all their efforts in pulling things together. Last but not least, thanks to all of you, ladies and gentlemen, for joining us today. We're very pleased to have had such a large and varied audience for this event. There's been a very interesting sort of side discussion going on, which has been sort of reaching the corner of my eye, and that's probably worth having a read back over at the end of this as well. Just before we pack up, can I mention a few of Jeffy's forthcoming attractions? Firstly, on 24th March, we have our latest Radical Old Idea interview, this time with Keith Skeach, the former CEO of Standard Life Aberdeen. And the next of these roundtables will take place in May, date yet to be finalised, when the presentations will centre around the theme of leadership, something which will no doubt be much needed in and around COP26. Perhaps the most important dates to note, though, are those of our flagship annual conference, Ethical Finance 2021, which will take place from 8th to 10th of June. As many people know, the event usually takes place in October, but this year we felt it made sense to bring it forward to 6 months prior to COP26, so that it becomes the centerpiece of our Path to COP26 campaign. Further information on all of these is available on our website, and of course, full details of our next roundtable will be circulated well in advance. I hope you'll all be able to join us again then, but for now, can I close by thanking our two speakers once again? And if you have been, thank you for listening.